Assalamu alaikum everyone, this is Ibrahim from Accountable. Today we are going to talk about accruals and prepayments. So this topic is not really that difficult, but it can be tricky, so you have to understand the basics and the T accounts, so of which we are obviously going to cover in this video. So obviously when a business is operating, you have expenses and you have your income. So you're obviously going to have an accrual and you're going to have a prepayment. So accrual is basically accrued expense basically is when you have incurred an expenditure but you haven't paid for it. For example, that you obviously have to pay a rent if you have rented premises, and you have incurred the rent of, let's say, $2,000, but you have not yet paid the rent, so your accrued expense of rent is $2,000, and since you have to pay that rent to your landlord, this is going to be a current liability for you. However, on the other hand, you have prepaid expenses. The best example for this is going to be an insurance premium account, when you pay for an expense prior to using the services, that meaning that you have paid in advance. Okay, so obviously since you have paid in advance, you still have not used that good or service, so you're going to treat it as a current asset in your statement of financial position. Now coming towards accrued income is, for example, you have sold your goods to someone. Okay, let's say you sold goods worth $500 to a credit customer, and since that's a credit customer, they have still not paid you, so that income is accrued. So which means is that the customer owes you $500, and that means those are your receivables. Okay, so accrued income is going to be treated as a current asset in the statement of financial position. Now moving on towards prepaid income. So prepaid income is when you have received an income in advance. Let's say, for example, rent of 5 months was given to you in advance. Okay, the businessman was saying that, okay, I'm going to pay you the rent for 5 months, and then we'll talk about it later. So he gives you, let's say, $10,000 for all the 5 months in just the beginning of month 1. So all those 5 month income is going to be your current liability, because you have received the money but you still have not provided your service or dispatched your goods to them. So this is just a small theoretical portion, just talking about definitions and the boring stuff, but now comes the more technical and the fun stuff. So let's have a look at the T accounts. We have an expense account, we've got an income account, but first obviously we're going to discuss the expense account. So you have to look at something, right? You see that I've written a P, A, and P. This is very important. So this P basically, as I have written over here, represents a prepaid expense, and the A represents an accrued expense. So since your prepaid expense is your assets, so obviously assets have a debit nature, right? Assets have a debit nature. So any opening balance of an asset is obviously going to be on the debit side. Therefore, any prepaid expenditure is going to be shown as an opening balance on the debit side, whereas the accrued expense opening balance is going to be shown at the credit side, because your liabilities have a credit nature, meaning that any increase in liabilities is shown by what? A credit entry. Now, okay, so this requires basic accounting knowledge. So why have we written cash/bank on the debit side? Because the thing was that when we paid for an expense, obviously we credited the cash or bank and we debited the expense account, right? Expense account. So now obviously we write the name of the corresponding double entry on the T account. So since I have debited the expense account, so I have to write the name of cash/bank, meaning that I can find the corresponding double entry in the cash account. Okay, I hope this helps you guys with this. So now the main thing over here to understand is that you have an A over here and a P over here. Since you have a debit opening balance for a prepaid expense, you're obviously going to have credit closing balance for prepaid expense, because obviously this balance CD and balance BD are opposites, and this would in the next session be your balance BD of prepaid expense, and your balance CD of accruals would, which you can see that balance CD of accruals on the debit side is going to be the balance BD of next accounting period on the credit side. I hope that this is not difficult. This is nothing. You just need to understand the basic T accounts, and inshallah I'll be working on a video about the basic double entries and T accounts as well. If this is troubling you, inshallah that video will help you guys out with this. So another thing, this income statement basically is your balancing figure. Okay, usually your balance CD and balance BD are the balancing figure, but in the questions of accruals and prepayments, they have usually given you the amounts. So your income statement is written on the credit side because you have to write the expense on the debit side of income statement. So when you're crediting your expense account, which okay, and debiting your income statement, okay, so I'm just gonna write statement over here. So this means that you've transferred the expense account, okay, which is why you have credited the expense account and debited the income statement in order to reduce the income, because income statement has a debit nature, okay, so a credit nature, not a debit nature, and any debit entry is going to reduce your income for the period. Okay, so now let's look into some questions of expense account. We've got over here, this is of November 2005. Looks difficult, isn't difficult, we have to relax. Okay, so Maria Van Zyl is a trader. Her financial year ends on 31st of July. She provides the following information. In accruals and prepayments related questions, dates and year ends are very important. Okay, so 31st July is the year end, which means 1st of August is the beginning of the year, right? So wages outstanding at August 2004, 1st August 2004, which means that your accrued wages, okay, because this is an expense account, I have to pay the wages, so the accrued wages are going to be on the credit side because this is my liability. So $200 over here. So now total wages paid during the year ended 31 July 2005, I'm going to write here cash and 61,300. okay. Now wages outstanding at 31st July 2005, wages outstanding, which means that this is the closing date, right? So this is our accrued expense but the balance CD of it. Okay, so we are gonna write over here balance CD, and what is it, 180. Okay, so our sum is gonna be 61,300 plus 180. It's gonna give us 61,480, and over here 61,480. So what are we going to show in the income statement, right? So income statement is going to be the balancing figure, so you deduct 200 from that, and in your income statement you will show that the wages expense for this period, that is for the year ended 31 July, is 61,280. So I hope I could help you guys with this question, and inshallah I'll be covering more examples and accrued income in the other video. Thank you.